If you've invested in property or you're thinking about getting started, cash flow is one of those topics that everyone talks about, but very few people actually explain it properly. Some investors obsess over it, some completely ignore it, and a lot of people misunderstand how it really works. In this video, I want to break cash flow down in plain English, what it is, how to calculate it properly, and how it impacts your borrowing power, and how experienced investors actually use cash flow as part of a broader strategy. By the end of this video, you should feel confident running the numbers on a property and understanding whether it actually fits your situation, not just whether it looks good on paper. So what is cash flow? At its most basic level, cash flow in property investing is simply the difference between the income a property generates and the expenses required to hold that property. That's it, the money in versus money out. When we talk about income, we're usually talking about rental income. When we talk about expenses, we're talking about things like loan repayments, management fees, council rates, insurance, maintenance, and all the other costs that come with owning an investment property. It sounds simple, but where people get tripped up is that they don't include all the expenses. They underestimate vacancies, or they rely too heavily on tax benefits to make the numbers work. If the income is higher than the expenses, the property has positive cash flow. If the income and expenses are roughly equal, it's neutral cash flow. And if the expenses are higher than the income, the property is negatively geared, or cash flow negative. Positive cash flow means the property pays for itself and then some. After all expenses are paid, there is money left over. This surplus can be used to build buffers, pay down debt faster, or help support other properties in your portfolio. Neutral cash flow means the property basically pays for itself. You might be slightly out of pocket or slightly ahead, but it's close enough that it doesn't materially impact your lifestyle or bank account. Negative cash flow means you're contributing money each week or month to hold the property. This is very common, especially in higher growth areas or capital cities. And it's not inherently a bad thing. The key is understanding how much it's costing you and whether that cost fits within your overall strategy. Now let's talk a bit about cash flow versus growth and why they play different roles. One of the biggest mistakes investors make is thinking cash flow and growth are opposing forces. They're not. They just play different roles. Growth is what builds your long-term wealth. It's what increases your equity over time and allows you to leverage more into more assets. Cash flow is what allows you to hold on to these assets. You can have the best growth property in the world, but if the cash flow is so negative that you can't afford to hold on to it, the strategy falls apart. On the other hand, you can buy a high cash flow property that never grows, and while it might help your income, it may not move you any closer to your long-term goals. The most successful investors understand how to balance growth and cash flow across their portfolio, rather than trying to force every property to do everything. Let's talk about how to actually calculate cash flow properly, because this is where accuracy really matters. Starting with rental income. This is not just the advertised rent multiplied by 52 weeks. You need to think in terms of gross rent versus net rent. Gross rent is the total rent collected if the property was rented 52 weeks of the year with no interruptions. Net rent is what you realistically expect to receive after accounting for vacancies and management. Vacancy allowances are critical. Even in strong rental markets, properties are not rented 100% of the time forever. Tenants move out, leases end, and properties need to be re-let. A conservative assumption might be 2 weeks vacancy per year, sometimes more depending on the location and property type. Ignoring vacancies is one of the quickest ways to overestimate your cash flow. Now let's look at expenses, and this is where people often miss things. Loan repayments are usually the biggest cost. Whether you're on principal and interest or interest only makes a huge difference in cash flow. Interest only loans generally improve cash flow in the short term, while principal and interest loans reduce debt faster but cost more each month. Interest rates also matter, and so do buffers. Just because your rate today is a certain number doesn't mean it will stay there forever. Sensible investors stress test their cash flow at higher interest rates to make sure the property still works. Property management fees are another expense that gets underestimated. Management fees, letting fees, and lease renewal fees all add up, and they can vary by state and by agency. Council rates and water rates are ongoing costs that you cannot avoid. These differ depending on the council and the state, but they need to be included in your numbers. Landlord insurance is also essential. It protects you against things like tenant damage, loss of rent, and liability. Skipping insurance to improve cash flow is a short-term decision that can backfire badly. Maintenance and repairs are another big one. Properties are physical assets, and things break. Hot water systems fail, roofs need repairs, and general wear and tear happens over time. A realistic annual maintenance allowance should always be included in your numbers. If the property is a unit or a townhouse, body corporate fees also need to be factored in. These can vary significantly and can change over time, so they deserve close attention. Depending on the complex, these body corporate fees can be a significant expense. One more thing to mention is how tax plays a role in cash flow. Depending on the property you buy, tax can have a large impact, but it should never be the foundation of your strategy. The first tax consideration is depreciation. Depreciation allows you to claim the wear and tear on certain parts of your investment property as a tax deduction. In Australia, depreciation is broken into two main categories. The first is capital works, which generally relates to the structure of the building itself. This includes things like walls, roofs, windows, doors, and fixed elements. For residential properties, you can usually claim a capital works depreciation of 2.5% over 40 years. The second category is plant and equipment. This includes removable or mechanical items such as air conditioners, hot water systems, ovens, dishwashers, carpets, blinds, and ceiling fans. However, since changes to tax rules in 2017, most investors can only claim plant and equipment depreciation on brand new assets, typically in new builds or substantially renovated properties. The key thing to understand with depreciation is that it's a non-cash deduction. You're not physically paying this money out of your pocket each year, but it still reduces your taxable income. That reduction in taxable income can result in a higher tax refund or a lower tax bill, which directly improves your after-tax cash flow. For example, if a property is cash flow positive by $5,000 per year before tax, but you can claim $10,000 in depreciation, that deduction may be the difference between you owing tax and getting a tax refund. Depending on your marginal tax rate, that could mean several $1,000s back at tax time. That being said, you should never be lured into buying a property for its depreciation benefits. Some property spruikers might try to sell you off the plan or new builds using its large depreciation deductions as a reason to buy it. However, these types of assets can often be the worst to buy as an investment property. And that brings us to negative gearing. Negative gearing occurs when the expenses associated with holding a property exceed the rental income it produces. This loss can be offset against your other taxable income, such as your salary or business income. In Australia, this is one of the most well-known features of property investing, but it's also one of the most misused. Negative gearing should never be the primary reason to buy an investment property. A tax deduction does not make a bad investment good. It simply reduces the pain of holding a property that's costing you money. If you're losing $1 in order to get 47 cents back in tax, you're still losing money overall. Where negative gearing can make sense is when it's part of a broader strategy. For higher income earners, negative gearing can help manage tax in earlier years of ownership, particularly when combined with strong long-term growth expectations or a plan to convert the property into a neutral or positive cash flow asset over time. From a cash flow perspective, negative gearing typically means you're funding a shortfall during the year with the tax benefit arriving later, often as a lump sum refund after you lodge your tax return. This timing mismatch is important. You still need to be able to afford the ongoing repayments and expenses during the year, regardless of the eventual tax outcome. An important thing to understand about tax on investment properties is how companies and trusts are treated differently. While these structures are often used for asset protection, estate planning, or income distribution, they come with very different tax rules compared to holding a property in an individual's name. Understanding these differences up front is critical, especially for investors planning to build a portfolio over time. One important consideration is land tax. In most Australian states, companies and trusts are subject to different land tax thresholds compared to individuals. This can result in significantly higher annual holding costs, particularly in land-heavy markets or where multiple properties are held under the same entity. From a cash flow perspective, this often catches investors by surprise. Another key difference is the treatment of losses. Unlike individuals, companies and trusts do not allow negative gearing benefits to flow through to personal income. If a property held in a trust or company is negatively geared, the loss is retained within that entity. That means the investor cannot use that loss to reduce their personal taxable income from a salary or business earnings. As a result, there is no immediate tax relief to help offset the holding costs in those early years, which can place additional pressure on cash flow. This is particularly important for investors who are relying on these tax deductions to be able to hold on to their properties. A positive to trusts is that they offer flexibility when properties become positively geared. Income can be distributed to beneficiaries in lower tax brackets, which can improve after-tax cash flow over time. However, this benefit only applies once a property is generating surplus income. In the earlier stages, when properties are often neutral or negatively geared, the lack of loss distribution can make trusts less cash flow friendly than your individual ownership. Now that we've talked tax, the next thing to understand is that cash flow is not static. It changes over time, and good investors plan for that. Interest rate movements can dramatically change cash flow. Rising rates increases repayments, while falling rates can improve cash flow. Rent increases can improve cash flow, but expenses also inflate over time. Insurance rates and maintenance costs tend to rise, and sometimes faster than the rent itself. Fixed versus variable loans also play a role. Fixed rates provide certainty for a period of time, while variable loans offer flexibility and access to features like offset accounts. Refinancing can also change your cash flow, whether that's by reducing interest rates, restructuring loans, or releasing equity for a renovation or another property. These all need to be considered when assessing your cash flow. So, by now, you've probably realized that there's a heap of considerations and variables that need to take place if you want to confidently calculate and forecast your cash flow. But don't worry, you don't need to fire up Excel and start trying to figure this out. We've done that for you. One of the things we focus on heavily is accuracy. We have created these detailed spreadsheets that factor in all income, all expenses, and realistic assumptions and future changes. These tools allow us to calculate and forecast cash flow across multiple properties, not just one. That's important because portfolio level cash flow is what really matters, especially as you're scaling. If you would like to learn more about this spreadsheet, you can watch the video linked down below along with the download link for the spreadsheet. Now, let's talk how cash flow impacts your borrowing capacity. This is a big one that a lot of investors don't fully understand. Banks assess cash flow very differently to how investors do. They apply rental shading, meaning they don't count 100% of your rental income. They also apply interest rate buffers to your loan. This means while a property may be neutral or even positively geared on paper, when the banks complete their assessment, this property will appear as negatively geared. A cash flow negative property can reduce your future borrowing power because it increases your assessed expenses without fully increasing your assessed income. Strong cash flow properties, on the other hand, can help you hold on to more properties, scale faster, and reduce your reliance on PAYG income. This is why cash flow becomes more important as your portfolio grows. Now, if you're currently holding negatively geared properties, there are ways you may be able to improve your situation. There are plenty of strategies investors use to improve cash flow, and they generally fall into either finance related or property related categories. On the finance side, interest only loans can significantly improve short-term cash flow. Offsets and cash buffers reduce interest costs while keeping funds accessible. And structuring loans correctly, including using strategies like debt recycling, can improve after-tax outcomes. And refinancing to lower rates can obviously improve your cash flow immediately. Another little known trick is setting up a PAYG tax variation. This allows an investor to adjust the amount of tax their employer withholds from their pay based on expected deductions, such as interest, depreciation, and other property expenses. Instead of overpaying tax all year and waiting for a lump sum refund at tax time, the tax benefit is spread across each pay cycle. For property investors, this can significantly improve day-to-day cash flow by increasing your take-home pay and helping cover holding costs as they occur, rather than relying on a once-a-year refund. On the property side, adding a secondary income stream like a granny flat or dual occupancy can significantly boost your rental yield. Short stay rentals can also increase income in some locations, though they come with higher management and vacancy risks, and can also have borrowing capacity impacts. Renovations can also increase your rent, but only if they're done strategically and don't result in overcapitalizing on the improvements. One last thing I'd like to cover is the common mistakes I see people make. Some of the most common mistakes I see include relying purely on tax refunds to hold a property, ignoring maintenance and other holding costs, overstretching on your borrowing capacity, assuming rent will always go up, and buying a property solely based on its cash flow without considering how it fits into the broader strategy. Hopefully this has given you a good idea of what cash flow is, how it's properly calculated, and how you can improve it in your situation. To sum it up at a portfolio level, not every property needs to be cash flow positive. Some properties can be growth focused while others are selected to support cash flow. The key is balance. A well-structured portfolio allows growth assets to do their job while cash flow assets help you hold on to them comfortably. At the end of the day, cash flow is what lets you sleep at night as an investor. Growth builds wealth, but cash flow lets you hold on to it. Every investor's strategy will look different depending on their goals, risk tolerance, and income position. The most important thing is that your numbers are accurate and your strategy is intentional. If you want help running the numbers properly and understanding how cash flow fits into your overall investment strategy, book a chat and let's go through it together. And if you found this helpful, make sure you like and subscribe for more educational videos like this.